Hey everyone, welcome back to Corporate Decoder. Today, NDAQ just filed an 8K, and I'm looking at a big change in their borrowing power. Quick note, this is not financial advice, just my take on public filings for educational purposes. Nasdaq just inked a pretty significant new credit deal that's going to affect how they can finance their operations moving forward. So here we are seeing an important update from Nasdaq Incorporated filed on the 1st of July, but the key event happened on the 30th of June of 2026. This is a current report, meaning something significant happened that the company needs to quickly report to investors. This form, the 8K, is like a company's pop quiz to the public. It is filed when major events occur that shareholders need to know about right away. Think big company news that could move the stock price. Nasdaq Incorporated is a publicly traded company, and their stock, along with some of their debt, is listed on major exchanges. This table is basically a checklist of the different financial instruments the company has out there that are subject to SEC reporting rules. You can see their common stock traded under the symbol NDAQ and various senior notes, which are essentially loans the company has taken out that are traded publicly. It shows they are a sizable company with a diversified financial structure. Now, for the main event, this section talks about Nasdaq entering into a material definitive agreement. In plain English, they signed a really important contract. And that important contract is an amended and restated credit agreement, which they're calling the Revolving Credit Agreement. What this means is Nasdaq has updated and essentially replaced their old credit deal with a new one. The previous agreement was from way back in December 2022, and it had been amended a few times. This new agreement, dated the 30th of June 2026, is designed to be their primary borrowing facility going forward. So what does this new deal actually do? It sets up a $1.5 billion credit line. Think of it like a giant credit card for the company. This is a revolving credit facility, meaning they can borrow money, pay it back, and borrow again over the next 5 years. It's described as senior unsecured, which means if things went really south, lenders would have a claim on the company's assets, but not as high a priority as if it were secured debt. This is a pretty substantial amount of borrowing power, and it shows the company feels confident in its ability to manage its debt and its operations. The fact that it's unsecured indicates a level of trust from the lenders in Nasdaq's financial stability. What can they do with this money? Pretty much anything a company needs to operate and grow. They can use it to buy other companies, pay off other debts they might have, buy back their own stock, which can boost the stock price, or just cover the costs associated with setting up this very credit agreement itself. This flexibility is key for a company that is always looking to expand or manage its finances efficiently. Now, no credit agreement is without its rules. This contract has standard clauses like making sure they don't lie about their situation. What happens if they default on payments, and rules about what they can and cannot do. A really critical one is a financial covenant. This means they have to keep their debt levels in check, specifically their leverage ratio, which measures how much debt they have compared to their earnings, can't go higher than 3.75 to 1.0. This is a common metric to ensure companies aren't taking on too much debt relative to their ability to pay it back. What is interesting is that this ratio can be temporarily increased for acquisitions, up to 4.50 to 1.00 for a couple of quarters, and then it steps down. This shows they have some leeway for strategic moves, but are still committed to managing their overall debt burden. For context, a lower leverage ratio generally indicates a healthier financial position. Beyond the leverage ratio, there are other restrictions. Nasdaq and its subsidiaries can't just take on unlimited new debt without approval. They also can't pledge all of their assets to secure new loans easily. Plus, there are limits on selling off major parts of their business or merging with other companies without adhering to certain procedures. These are common safeguards for lenders to ensure the company doesn't significantly weaken its financial standing without their knowledge or consent. This new credit facility is set to mature on the 30th of June 2031. That means all the money borrowed under this agreement needs to be paid back by then. This provides a good long-term outlook for their financing needs. And importantly, as of the 1st of July 2026, there were no outstanding loans under this new facility. This means they've just secured this large borrowing capacity, but haven't tapped into it yet, suggesting they likely have sufficient cash on hand for current operations. Moving on, there is a section about the termination of a material definitive agreement. This is directly related to what we just discussed. Since they entered a new credit agreement, their old one is no longer in effect. So this item essentially states that the old credit agreement has been terminated because the new one replaced it. It is a formality to make sure all the legal bases are covered. Another related item here is the creation of a direct financial obligation. This item simply points back to the new credit agreement. It confirms that this new revolving credit facility is now a direct financial obligation of Nasdaq Incorporated. It is another piece of the formal reporting puzzle, making sure investors are aware that this new debt facility is now officially on the company's books, even though they haven't drawn on it yet. Finally, we have the exhibit section. This is where the actual legal documents that back up the report are listed. Here it is, Exhibit 10.1, the amended and restated credit agreement itself. This is the nitty-gritty legal document that governs the entire $1.5 billion credit facility. It is filed alongside this report, and you can bet it is packed with all the legal terms and conditions we touched on, and many more. While we are not going to dive into every single clause, this is the foundational document for their new borrowing power. One quick note here is that some parts of the agreement, like detailed schedules or specific exhibits, have been omitted. This is often done for lengthy documents to keep the main filing cleaner, but Nasdaq is agreeing to provide them if the Securities and Exchange Commission asks for them. So what does all this mean? Nasdaq has just secured a massive $1.5 billion credit line. This is positive because it gives them significant financial flexibility for future growth acquisitions or managing their day-to-day operations. It signals that major banks like Bank of America, acting as the administrative agent, have confidence in Nasdaq's financial health and future prospects. They are essentially saying, "We trust you to borrow this much money and pay it back." The fact that they haven't drawn on it yet is also a good sign, indicating they likely have strong cash flow or are simply securing this capacity for strategic reasons down the line. The covenants in the agreement show they are committed to responsible debt management, which is crucial for maintaining investor confidence. For a company like Nasdaq, which operates in the fast-paced financial services and technology sector, having access to significant capital on favorable terms is a competitive advantage. It allows them to react quickly to market opportunities and navigate potential economic uncertainties. The 5-year term of the facility also provides a good runway for their strategic planning. My biggest concern is always how companies utilize large credit facilities. While flexibility is good, taking on too much debt, especially for acquisitions that don't pan out, can become a drag on earnings. However, the leverage ratio covenants are a strong indicator that they are aware of this risk and are being held accountable. What I am actually looking for next is how they choose to deploy this capital, whether it is through strategic investments or strengthening their existing operations. The key will be whether these actions lead to sustainable growth and profitability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.